Hello, and welcome to another installment of Paul's Thoughts About Everything. I'm Paul Carmen, and I'm an advisor with LPL Financial based in Boca Raton in Palm Beach, Florida. While my offices are in Florida, I'm licensed in and serve clients in other states as well. If you'd like to drop me an email with comments or suggestions, please contact me at paul.carmen@lpl.com. That's paul.carmen@lpl.com. Today, I'd like to talk about a subject that, if we're lucky, will affect us all, and that is getting older. There are many challenges associated with aging, and for this installment, I'm going to touch on a few. In the 1950s and the 1960s, the average lifespan was about 65 to 70 years old. We typically worked until retirement at age 65 and went on Social Security before passing away approximately 5 to 7 years later. People who lived beyond their 60s were not as mobile or social as those in their 60s and 70s today. Many of today's over 65ers are actively working and leading healthy physical and social lives. I have friends who play tennis well into their 80s and golf into their 90s and beyond. Diet, exercise, and improvements in medicine have vastly improved, and Americans are living longer and healthier lives. There's a negative side to this improved longevity, however. Living longer may improve mortality, but it has also led to an increase in morbidity. In other words, people are living with illness for much longer periods than previous generations. This has led to an increased need for help and care for longer periods of time, as 7 in 10 people turning 65 will need some form of long-term care during their lifetime. Insurance companies have responded with different types of long-term care insurance, which, if one can afford it, can provide funds for various levels of care if needed in the future. It can be a valuable asset if thoroughly researched and proper coverage is implemented. Some coverage considerations should include insurance company rating and strength, because you don't want to be on claim or uninsurable in the future and have problems with your insurance company. Premium rate increases, which most insurance companies are allowed to impose under specific conditions. Types of insurance, length of coverage, amount of daily or monthly benefit, direct pay or reimbursement plan, policy exclusions, if any, premium ratings, cost of living increases, simple or compounded, and that makes a big difference, and amount of coverage, and as well as any additional benefit options. One of the downsides to traditional long-term care policy is the use it or lose it nature of the contract. If benefits are not needed, the policy has no value. There are hybrid life insurance contracts known as asset-based policies that are typically funded with a single large premium or fixed schedule premiums and are designed to allow access to a portion of the death benefits if long-term care benefits are needed. If long-term care benefits are not needed, the death benefit would pass to beneficiaries. This might be a good alternative to the use it or lose it standard long-term care contract. Some insurance companies have developed a long-term care rider that can be attached to a traditional life insurance contract. This typically involves increased underwriting requirements, though, as policy and rider are medically underwritten. Chronic illness riders are available for some life insurance contracts for those who are in good to excellent health and want to pass a death benefit along to their beneficiaries. This rider provides coverage for permanent qualifying conditions only. Fixed or index annuity contracts with long-term care riders have become a popular alternative. There is a base annuity contract with a built-in long-term rider attached. The annuitant can use the accumulated value of the contract to pay for qualified expenses, typically on a tax-free basis. One of the pros about using an annuity for this purpose is the long-term care rider can increase your monthly benefit with no increase in premiums because you control what premiums, if any, are paid. It provides tax-advantaged structure for benefits, and the remaining value, if any, would pass to heirs. Your advisor should help you determine whether long-term care coverage is right for you and the pluses and minuses of each type of coverage as it relates to your specific needs. He or she should be well-versed on the types of coverage available, company claims paying ability, and changes to the industry. Thank you for listening, and if you have any comments, again, please feel free to reach out to me at paul.carmen@lpl.com. That's paul.carmen, Carman, @lpl.com.